Senate pushes to pass President Trump's spending bill, with all eyes on Washington's growing deficit. Senate Republican leaders continue to scrounge for votes to pass President Trump's sweeping tax cut and spending bill on Tuesday. Trump wants the bill passed before the July 4th Independence Day holiday, but divisions are emerging over the expected $3.3 trillion hit to the nation's debt pile. So what's the real impact of Trump's big, beautiful bill? Elliot Hentoff is head of macro policy research at State Street. So, Elliot, trillions of dollars could be added to the $36.2 trillion national debt. Should we be worried about the state of the country's finances?
Well, it's a few $1 trillion more to a large pile of debt. No, in seriousness, yes, we should be worried, and investors are worried. We've seen an uptick in the risk premium, the term premium, so the risk premium on longer term U.S. debt over the past 2 to 3 years, and I would expect it to continue to climb. What it's not, though, is this is not a pivotal moment. This is not a Liz Truss moment in U.S. history, because what we're seeing is just a continued erosion of fiscal sustainability, but not a watershed break.
Could we see investors compelled to dump treasuries, or even worse, a cut to the U.S.'s credit rating over the swelling debt?
Well, we've seen cuts to credit ratings. I used to be a sovereign analyst at S&P, so I know what sovereign downgrades look like. Yes, over time, it's probably likely you're going to see more. We've already seen the step down from AAA. The dumping of treasuries, though, there's no evidence for that. We have not seen, even in stress periods, investors exit U.S. Treasury positions en masse. We have not even seen a reduction or a buyer's strike either. But we are seeing a very fundamental shift in who's buying U.S. Treasuries and at what rate. And so you've had foreign official buyers like central banks. They've exited the market very gradually in recent years. We've had other foreigners dip in and out, and we've obviously had the Fed reduce its holdings. And what you're left with are buyers, particularly domestic savers and domestic institutions, who are price sensitive. And so they're happy to continue buying, but they want a yield that reflects that is attractive to them. So they're much more price sensitive, and that means the yields are going to stay sticky on the high end.
Let's look at the details of the bill as well. Republicans have said that the tax cuts will help families and small businesses. Will the market feel the stimulus?
Yes, we do. We think this is stimulative bill, and you'll start to see it. It's one of the reasons our forecast is for growth to slow this year, but to pick up in 2026, because the stimulus adds about 0.5, maybe 0.7% of net fiscal thrust. So a little bit of a stimulus. I don't want to exaggerate it, but you should see it. You should see it particularly on corporate earnings and a little bit on certain households that get a benefit from the tax cuts. So stimulative, yes, not too big though, and I wouldn't exaggerate it. But it's not a long-term stimulus. That stimulus will fade over the 2 to 3 year time horizon.
So how will the Fed be interpreting the effects of the bill? Will this prolong Fed Chair Powell's wait-and-see approach to easing rates?
That's an excellent question, because the Fed has to think of a lot of different variables. And you can see right now they've basically deferred to uncertainty as a reason for not to cut yet. Some of the data that has come through suggests a slightly weakening labor market. It suggested price stability, and yet we haven't seen rate cuts. The bill will add to this uncertainty because it's not fully clear to the extent this will actually be inflationary or not. I'm rather skeptical myself that this will actually add to inflationary tailwinds. But what it does do is the growth in U.S. debt is a problem that does transmit to the economy, and so the Fed will have to think about, the trade-offs in terms of leaving rates higher and being constrictive, and also putting on constrictions on the sovereign, so to speak, and the effects of the economy versus the underlying inflation trends. In a nutshell, I actually think the case for rate cuts will grow in the coming months.
So finally, Elliot, Trump's political pressure has extended to the Fed as well. He's expected to announce a successor to Powell soon. How will the market read a shadow Fed chair?
Half of central banking is market communications. That is really half the function of central banking. And once you have a shadow Fed chair, that function will be impaired. It'll basically remove longer term forward guidance once the shadow Fed starts communicating, and therefore the Fed's core functions will really be limited to very near-term rate decisions more than anything else, and the forward guidance communication will start to erode.
Elliot Hentoff, Head of Macro Policy Research at State Street. Don't forget, you can watch more videos on Reuters.com.